Until the end of last year, I was working at Questrade, which is one of Canada's fastest growing fintech companies. And at the time, I was helping clients open up accounts, understanding what their needs were, and really getting them started in the market. And a lot of the things I saw then was that there was this euphoria, and it was great seeing individuals take financial independence, but there was this like get rich quick mentality and almost feeling that you just throw money into the market, into any stock, and it's automatic that you are going to become rich. And I wasn't able to really express my opinions the way I wanted to. So I kind of had to sit there and hope for the best. And at the time, the market was going up, and I'm sure a lot of the people saw their friends making money, and this is what got them into the market. But now we see that it's a time where the market, and especially growth stocks, have been getting hit pretty hard. And now that I am posting more on YouTube, I have the opportunity to talk about this downturn, how to approach it, and really how to approach the market in general, so you wouldn't be surprised by these downturns, and strategies that also protect you through them, and ultimately you come out on the other side profiting. So today I want to talk about why the market is the way it is so far in 2022. Can this continue? When it could potentially stop? And some strategies to approach this market. So firstly, you have to understand that although we're talking about investing in 2022, really your outlook should not be how to invest in 2022, because ultimately investing is about the long term. If you're starting to invest now or putting money in now, it definitely should be seen as a long-term approach, which means we're really just looking at different market cycles, which in 2022, we happen to be within one. So in order to explain what is going on in this market cycle, I think it is important first to understand the difference between growth and value stocks, since right now it is growth stocks, mainly non-profitable ones, that are getting hit the most. And ultimately out there in the market, it's about different portfolio managers and hedge funds, because that's where most of the money is at. They are year to year looking at different market opportunities, and they are shifting their money from one part of the market to the next. As the long-term investor, retail investor, we have that advantage of time. So not necessarily do we have to take this approach, because we're not subject to our clients that need to see certain things in that given year. But it's still very important to understand these different sides of the market, and why at times one is getting hit more than the other. So the value stock is the traditional stock, in the way that all the regular traditional value metrics apply to it. So for example, I'll take Home Depot. This would be considered a value stock. Typically they pay a dividend, and it's really that you can look at Home Depot and you can say, okay, with 100 locations, these are the exact costs and these are the exact revenue that they make from them, and ultimately this is their profit. This means that if Home Depot is planning to grow this percent, which is opening 2 locations here, 2 locations there, then this is exactly what the cost should be based on the past valuation of its other locations. This is really how value stocks, they kind of work in linear forms. They usually don't have much up surprises, much easier to see in the financials. And this is something that many portfolio managers only focus on, because all the traditional metrics kind of line up exactly with value stocks. So you can kind of say, oh, this one is cheap based on all these metrics, or this one is expensive because of all these metrics. And usually with value stock, it's pretty spot on. When it comes to growth stock, everything changes, because growth stocks are really, it's about the profits in the future. It's about the market opportunities going forward. So people are really looking at this stock and investing for the future, which means it's very hard today to start applying all these different valuation metrics, because they typically don't move in linear terms, they are more exponential in their growth rates. So if you're trying to say, I'll take Amazon as an example, that they open in 2000, this is their profits. So if we think that they're going to expand at this rate, then their profits are going to be X value, then this is what their valuation should be. The problem is Amazon basically jumped into other product lines and other parts of the market that grew their profits beyond what we could have imagined based on what they started with as just an online bookstore and then an online e-commerce company. And now, because of all the data that they were able to collect, they built out their Amazon Web Services company, which is the most profitable part of their company. And these are all metrics that couldn't be seen by the traditional value metrics that how they used to value a company. And this is why growth stocks, it's much more about looking at the management, believing in the future, and many metrics beyond the traditional ones. So this is really the divergence between the two. Usually also value stocks have pay out a dividend because their profits are very linear. They know the profits that are coming in, and ultimately they pay that out to the shareholder, while growth stocks are more reinvesting in the company and really putting profitability on a hold in order to grow that company. Now we have to understand that for both stocks, although we see that they're valued differently, value stocks are off the traditional metrics, while growth is about the future profits. And that's why usually they have a higher price to earnings ratio, because we expect them to grow at an exponential rate going forward. Now the question is, what happens if, on the one hand, these growth rates are reduced? Then growth stocks would have their valuations taken down from the levels that they are, because we're expecting less growth. And also we have to understand that whenever you value a company, whether it's growth or value, you're always valuing it relative to the risk-free rate. And the risk-free rate is basically how much money you will get on what you invest at zero risk, and this is treasury bills. Treasury bills are seen as zero risk, and if you invest in them, then you are getting a certain amount of money without paying any risk. So obviously, if you're going to invest in a company, or whether it's through their stock or bonds, you will expect more than the risk-free rate because you are taking on more risk. But it's always valued against that. So we have to understand, if the risk-free rate is going to go up, then we would need to expect higher percentage growth from the companies that we're investing in. And usually companies, by the risk-free rate going up, doesn't mean that they're just going to be able to expand their profits. If anything, it's going to go down, because now they have to borrow at a more expensive rate. So it means that our valuations are going to have to come down. And growth stocks, the most, are going to come down because, like I said, they usually have that higher price to earnings that is going forward. We see here from the money supply that there's a huge increase in the velocity of M2, which is money in the system. And this is very much from the Fed printing a lot of money and all the stimulus packages that were received throughout COVID. And this was something, whether it was necessary or not, this was ultimately the reality. And because of this, this creates a lot more money in the system, which makes it a lot easier to borrow money at lower rates. And as we see here in this chart, that rates have been at its lowest and really at unprecedented levels. And even now, with the starting of rising rates, it's still at this extremely low level. So this all means that on the one hand, companies are able to borrow money at a lower price, but it also means that there's so much money in the system that could ultimately find its way into asset classes, which will obviously make them go higher. So the reason why this is looked at now at as starting to kind of stop in terms of this money supply and the growth that we have seen since COVID has started is because of the inflation data that has come out. So if we see on this chart, we see that inflation has actually the other month hit a high since 1982. And ultimately, inflation comes because when you have that much money going around in the system, it just ultimately means that prices will go higher. For just to give an easy example, that it's not as much about the money supply or the money in the system. It's really about the cost of living that matters and what we should focus on. Many times politicians don't. They see that throwing money and putting money in the system is definitely better for the campaigns and makes them look better. But ultimately, the cost of living is what the most important factor is. For example, imagine we all got $10 million tomorrow in our bank accounts. That doesn't mean we would all be able to go out and buy a Ferrari, because the price of the Ferrari would just go up by that much. It's all about the supply that there is and the supply and demand that creates the prices. So the price of the Ferrari would just go up by that amount, and then we would be the same well off before we receive that money. Also, as a quick side point, this is one of the big reasons why I own Bitcoin, amongst other reasons, and I'm actually working on a video, so please look out for that. So because of these inflation levels, finally the Fed has realized that there is too much money in the system, and they, on the one hand, need to do some quantitative tightening, which means up until now, since pretty much the 2008 crash, they have been buying a lot of bonds and assets in order to, again, put money into the system, and they realize they need to tighten and start selling. And at the same time, they are starting to they talked about raising interest rates already 3 to 4 times this year. And this is, again, we see that interest rates are extremely low, and this will go higher. So what this means for growth stocks is, on the one hand, companies that are unprofitable, we're looking at their future profits, they are going to have to now borrow at a higher rate, which obviously puts pressure on them. But also going back to, we are investing relative to the risk-free rate. Now, if that goes higher, then we are going to have to expect a higher return, or the multiples of how we value the stocks are going to have to come down. So we see this playing out, and this is the reason why growth stocks are getting hit so hard. And really, the volatility is also coming from just, we don't know exactly how the Fed is responding. We know that they're tightening and they're raising rates, but we don't know to exactly what extent, because the Fed first said that inflation was only transitory, so it would be less of a problem. But then we see that it is not, and they took on the approach that it's not transitory, which means inflation is for now here to stay. And because of this, they have to tighten. So the market is trying to get a read of what the Fed is actually going to do going forward, and because of that, it adds to the volatility. Now the question then becomes: are growth stocks dead and their end of their bull market, and is it now similar to the 1999 dot-com bubble, where there was all this euphoria and now the market started their downturn? I don't think so. I think that there is a huge divergence between today and the dot-com bubble, which means I believe that growth stocks will continue to face this pressure. No one can tell you for exactly how long. I think it will be until the market gets a read on what the Fed's planning on doing going forward. And I want to show these few charts which kind of show the difference in time. So first of all, if we look here, we see that the multiples were definitely a lot higher during the dot-com bubble, although yes, we are still at high multiples, and this is why we probably are seeing some compression on these stocks. However, we have to understand that more than just it not being the same multiples at the dot-com bubble, we are at a time where profits are at an unprecedented rate. So at the dot-com bubble, I like to look at that's when all the ideas of all the new innovations were. And the problem is people threw money at it a little too early because the companies they weren't profitable yet. Everything was about the idea of what it will be. But I think today this is actually when companies are starting to act and have started to act on these innovations. And if we look at these profits. For example, looking at the top S&P 500 stocks, the Apples, Amazons, Microsofts, Facebooks, and we see these profit levels are really something never seen before. And because of this, they are weighted so much in the indexes. And because of this, so many people want to own these stocks. They see them as almost risk-free stocks to a certain extent. And these companies are still growing at tens of percent growth. So they're still growing. They are making huge profits. And this was something that was not during the dot-com bubble. And a lot of other companies, even that are unprofitable now, they are close to profitability and they're starting to disrupt industries that only the idea was there in 1999. So I don't think we're in that same kind of bubble. I do think that the market was getting ahead of itself in certain industries. So, for example, in EVs, I think all you had to do was talk about EVs and your stock price would go up and have a re-rating. And this was sometimes beyond what you could imagine for a car company when only two of them have gone bankrupt in the last century. So, but we really see that prices have come down in these. So that is a good sign to me. So I don't think that we're in this dot-com bubble era. I think that what is important to do at this time is realize that when you're investing for the long term. So it might be very painful now, but you have to look at, for example, if we see in this chart, even at the top of the peak of the dot-com bubble, Amazon, if you bought it then, and then you look out till today, you would still be up almost 3,000%, which means you have to, at this time, really stick to your highest conviction stocks and make sure that you have, they don't need to be at the right value in the sense of the traditional metrics, but you have to understand that if they're overvalued in those metrics today, you have to know how they will reach that valuation at a certain point. So you have to see that growth going into the future instead of it being like a sector, for example, space, and you get all excited and, oh, space could be huge, so let me put all my money in, for example, Virgin Galactic. You really have to, even if it's overvalued today, like Tesla's overvalued, that doesn't mean anything to me because I see their growth and how they'll grow into that valuation and more. So you need to know that. And once you get to that point where you have your highest conviction stocks, then you just dollar cost average. I mean, we went through this cycle in 2018 where the Fed was going to raise interest rates. And as they did, the stock market went into a bear market. But ultimately, it came back. And the reason is I can't see the Fed raising interest rates to the level as we see here in the end of the 1970s, 1980s, because ultimately, because of how big the U.S. deficit is, they will end up having to pay most of their budget towards just paying interest on their own debt. So I don't think interest rates. I mean, we're coming off a very low level, so even a few percentage points is not that crazy if you're investing in companies that will have growth rates much more than that. So I would say again, stick to these high conviction stocks. And you dollar cost average, and in the grand scheme of things, you will come out the other side. And it's always said that the market is the one sale in town that people don't buy in. So this is because of human emotions. We see green, we want to jump in, but when we see red, we get all scared. The red is when you want to buy, because ultimately, if you see the stock price, let's say it's at $50, and you say in 5 years it's going to be $200. And if it goes down to $25 and nothing changed with the company, then maybe there is a re-rating of some sorts that you can look at. But ultimately, you're getting a golden opportunity to buy that at a cheaper price, which means your profits will be a lot higher at the end of the 5-year period. What happens in the short term should not matter. And I would say that if you're not as convinced on specific stocks or you're newer to investing, and you want to kind of diversify, I would say, first of all, you can always take the ETF method. So you're investing in the benchmarks, and you can split this up to invest in the QQQ, which is the NASDAQ and is more tech stocks, and the VTI total stock market. And really with each dip, you can start to allocate towards the market in those ways. And really what this means is you have to be less of a expert on specific stocks. Ultimately, as we see on this chart, the market has been going up for some time now, and it has dips all the time and sometimes massive dips, but look at where we are today. And ultimately, the profits are growing. So you can definitely take this method. And another one is over here, I created this portfolio. It's just a mock portfolio, so don't look at the stocks and think, oh, this is investment advice. Not at all. I randomly put in names that popped into my head, but you can kind of on Excel play around. It's very easy to build portfolios, put different percentages, and you can make a very diversified portfolio by putting some in value that pay out a dividend, and then you will be kind of, even if in this downturn, you will be getting a dividend, and if you reinvest it, it will be reinvesting at a lower price. And then you can put some in growth values. Here I took, for example, Microsoft and Google, and you can put in some growth, and then some speculative growth, which was more lemonade, and some crypto if you want. And then I would say that you always want some cash in this time period in order to allocate more towards the market as it comes down. And sometimes what I always keep cash in general, because I always want some liquidity, because we can never tell when there is a bit of a peak and when there will be a downturn. So I always kind of want to be ready. But what I definitely do is, and again, this is not investment advice, this is just something I do, is if I see one or two very big down days, I'll maybe lighten up my cash position a little more than usual. But if the next day there's a big up day, then I'll sell again. So if I got 3% in one day because the market had a 2-day flush out, then I'll get back to those 10% cash levels and kind of continue that process slowly. But at the same time, I'll be putting into my highest conviction names. And I do this also in 2 different accounts, so I don't get mixed up by the little bit of trading, this volatility versus the long-term investments. So again, what I would say is that it is important to look out in the where the market has come from, where it is. And yes, there are these periods of market fluctuation and downturns, but you want to take this as an opportunity to, whether you're getting into the market or if you're still allocating towards the market. And ultimately, those who have been in equities over the past century have done very well if it was in a very diversified, smart way, or if you are an expert on specific stocks and you want to take that risk. So really good luck. We don't know when this is going to end. I will continue to update if there are different changes in the market. Thank you so much for watching. Please like and subscribe, and bye for now.